Price charts are a trader's friend. They provide statistical information on supply and demand in a market in a way that makes interpreting the information easier than looking at a set of numbers. Supply and demand is created by orders made by traders, institutions, and computers. Each decision to place a buy or a sell order is taken based on judgments or assessments made with a view to making a profit. Traders use different timeframes, different systems, and methods to make decisions, and what may trigger a sell order for one trader may also trigger a simultaneous buy order for another trader. This two-way process is how trades are enabled. Orders create liquidity. Traders thrive on liquidity and volatility in markets. When prices are moving, then traders are making money. When more traders see buying opportunities in a market at a certain price than traders looking to sell at that price, then they are in competition with each other. There's a temporary imbalance in the market, and buyers will need to pay more for their purchase in order to attract sellers on the other side of their trade. This is how supply and demand works throughout the day on every market. When price rises to a certain level, then buyers become quiet. The sellers are entering the market. Some traders are looking to sell to take profits, and others want to bet on falling prices. There's an imbalance once again, and the market needs to go down. Price charts show us a never-ending pattern of ebbing and flowing between supply and demand. Sometimes the market balance is quite even and the price moves are small. Other times the market imbalance is greater and there's a clear momentum in one direction or another. Still, other market conditions can see huge swings between up and down as the battle is fought between supply and demand. In the moment, all traders are looking at the same price information, but they're looking at it in different ways. The two most common forms of price charts are line charts and candlestick charts. Price is represented over periods of time between monthly price periods and 1 second price periods. Line charts are a join the dots exercise. Each line represents one time period and the dots are created by the price that exists at the end of the specific time period. As one time period closes, so another one opens and a line's created which moves until the end of the next time period. Candlesticks provide more information. They begin with the opening price of a time period and they form as price moves throughout the time period. At the end of the time period, they leave an imprint depicting the open, the high, the low, and the close prices within that time period. The most common time periods analysed by traders are the daily, the 4-hour, the 1-hour, the 5-minute and the 1-minute time frames. Each 5-minute time frame candlestick contains 5 1-minute candlesticks, and each 1-hour candlestick contains 60 1-minute candlesticks. A trader will pick a favourite time frame or set of time frames based on the system that they're using, the type of trades that they're looking to take, and the time that they've got available to spend at their trading stations. A trading setup that looks good on one time frame may not look as good on another time frame, and generally the more time frames that say the same thing, then the better the odds of a move in the market being successful, as more traders are going to form the same opinion, thus creating greater supply or demand.